What if I told you that the Federal Reserve's next move could make certain AI stocks explode in value, but only if you position yourself before it happens? The three best AI stocks before the Fed cuts rates aren't the ones everyone's talking about. And if you miss out on understanding why interest rate cuts create a perfect storm for specific types of AI companies, you could be leaving serious money on the table. Here's what most investors get wrong. They think all AI stocks benefit equally when the Fed cuts rates. That's not even close to true. In fact, there's a specific type of AI stock that historically outperforms by nearly 2 times during rate cut cycles. And today, I'm going to show you exactly which 3 AI infrastructure companies are positioned to dominate as borrowing costs drop and spending accelerates. Your time is valuable, so here's everything we'll cover. Why the Fed's December rate cut creates an unusual opportunity for smaller AI stocks, the 3 AI infrastructure companies set to benefit most, and the data that proves growth stocks crush value stocks during rate cutting cycles, sometimes by as much as 100%. Let's start with why timing matters. The Federal Reserve's next meeting ends on December 18th, and economists are predicting another rate cut with near certainty. Now, here's what you need to understand. When the Fed cuts rates, 2 things happen simultaneously. First, lower interest rates mean companies can borrow money more cheaply. That means more capital expenditure, more expansion, and more revenue growth for the companies selling products and services to these borrowers. Second, and this is what most people miss, lower rates make bonds and savings accounts less attractive, which pushes more money into stocks. That means higher price to earnings ratios, higher valuations, and bigger gains for shareholders. So you're getting a double boost, higher earnings, and higher multiples. But here's the kicker. Historical data shows that after the Fed starts cutting rates in an expanding economy, which is exactly where we are right now with GDP growing at 3% annually, the S&P 500 returns an average of 20% over the following 12 months. But when you break that data down further, something fascinating emerges. Growth stocks don't just slightly outperform value stocks, they absolutely dominate them. During rate cut cycles in expanding economies, growth-oriented stocks have historically returned almost twice as much as value stocks at nearly every point in the cycle. Why does this matter for AI? Because we're in the middle of the largest infrastructure build-out in modern history. Microsoft, Amazon, Google, and Meta are collectively spending hundreds of billions of dollars per year building AI data centers. And as rates fall, that spending accelerates even faster. So here's our strategy. Find smaller, high-growth companies that are directly supplying this massive AI infrastructure boom. Companies sensitive enough to interest rates that they'll surge as borrowing costs drop, but essential enough that hyperscalers can't build without them. That brings us to our 3 picks. First up, CoreWeave, ticker symbol CRWV. Think of CoreWeave as the specialized contractor everyone needs but can't afford to become. While tech giants are building their own data centers, they still need overflow capacity, rapid deployment, and access to cutting-edge hardware without the years-long wait times. CoreWeave operates 41 purpose-built AI data centers across North America and Europe, housing over 300,000 Nvidia GPUs. But here's what really matters: power capacity. Most data centers are constrained by electrical infrastructure. CoreWeave has secured over 0.5 gigawatt of active power and nearly 3 gigawatts of contracted power capacity, enough to run over 1.7 million next-generation GPUs. And they have something almost no one else has: priority access to Nvidia's latest chips. When Nvidia releases new architectures like Blackwell or the upcoming Vera Rubin, CoreWeave gets them first. That's a massive competitive moat. The numbers tell the story. CoreWeave's revenue grew 134% year over year in their latest quarter. But here's the really interesting part. They have a $55 billion backlog of committed revenue. Read that again. $55 billion in contracted business already on the books. yet their market cap is only $44 billion. Think about that. The company is trading below the value of its committed revenue pipeline. OpenAI alone expanded their agreement by $6.5 billion last quarter, bringing their total partnership to over $22 billion. Meta signed a $14 billion deal running through 2031. Microsoft has roughly $10 billion in contracts for Azure infrastructure. These aren't speculative partnerships, these are multi-year locked-in revenue streams. And as the Fed cuts rates and these companies can borrow more cheaply to expand their AI operations, CoreWeave is positioned to capture a significant portion of that increased spending. The smart computer companies figured it out early. They built the necessary infrastructure. They achieved customer lock-in. And now they are so far ahead that they have created advantages that competitors simply cannot copy, no matter how much money they throw at the problem. Most investors feel smart because they bought a stock with tech in the name. But feeling smart and making real, consistent money are two different things. The true winners, the ones that will dominate 2026, are executing quietly, building complex systems, and creating barriers to entry that are effectively impossible to breach in the short term. This is why generalized investing fails, and specific intentional investing in infrastructure succeeds. Next, the second stock, Arista Networks, ticker symbol ANET. Here's what most people don't realize about AI. The actual computation is only half the battle. Modern AI training involves breaking up massive datasets across thousands of chips, processing them in parallel, and then recombining the results. If your network can't move data fast enough, your expensive GPUs sit idle waiting for information. That's where Arista comes in. They build the specialized networking equipment and software that connects AI clusters together. Their Ethernet switches are engineered for extreme speeds, minimal latency, and maximum reliability. Exactly what you need when a single network bottleneck can waste millions of dollars in compute time. Arista's secret weapon is their operating system called EOS. It runs across all their equipment, allowing data center operators to manage thousands of network nodes, automatically balance workloads, monitor system health, and solve issues before they cause problems. It's the nervous system that keeps AI factories running at peak efficiency. They also partner closely with Broadcom, building their switches around Broadcom's cutting-edge Tomahawk chips. This gives them a technology edge as network speeds continue doubling every few years. The market opportunity is staggering. The global AI infrastructure market is projected to grow nearly 19x over the next 9 years, a 38% compound annual growth rate. That's 3 times faster than the overall S&P 500. And remember, this projection was made before the Fed started cutting rates. As borrowing costs fall and tech giants accelerate their build-outs, Arista is positioned right in the middle of this spending surge. When Amazon, Google, Microsoft, and Meta spend billions connecting their AI clusters, they're buying Arista switches and software. And as those networks grow larger and more complex, Arista's expertise becomes even more valuable. Finally, stock number 3, Micron Technology, ticker symbol MU. Every AI system has a hidden bottleneck that most investors overlook: memory bandwidth. You can have the fastest chips in the world, but if they can't access data quickly enough, they're not doing anything useful. That's like having a race car with a gas tank the size of a thimble. Micron specializes in high bandwidth memory, specifically HBM or high bandwidth memory. This isn't your laptop's RAM. HBM involves stacking memory chips vertically and connecting them through an incredibly dense interface, allowing data to move at speeds that would be impossible with traditional memory architectures. Here's why this matters. Modern AI models have trillions of parameters. They need to process enormous data sets at blistering speeds. Traditional memory would create massive bottlenecks, making training impossibly slow and inference painfully expensive. HBM solves this by moving data faster and using dramatically less power, by reducing the physical distance information needs to travel. Micron controls over 20% of the global DRAM market, making them one of only 3 major players alongside SK Hynix and Samsung. But here's an interesting angle. Both of those competitors are South Korean companies that could potentially face tariff headwinds. Micron, as a US company, sidesteps that geopolitical risk entirely. The growth trajectory is remarkable. The AI memory chip market is expected to grow 9x by 2034, a 27% compound annual growth rate sustained over 9 years. And Micron is already seeing that growth materialize. Their DRAM business represents 79% of total revenue and grew 62% year over year in their most recent quarter. As AI models get larger, as reasoning capabilities expand, as inference becomes more complex, all of these trends point toward exponentially increasing demand for high bandwidth memory. And Micron is one of the few companies in the world that can supply it at scale. So let's connect all the pieces. The Federal Reserve is cutting rates in an expanding economy. Historically, one of the best environments for growth stocks. Tech giants are in the middle of a multi-hundred billion dollar AI infrastructure build-out, and we've identified 3 companies supplying the essential components that every AI data center absolutely needs: compute capacity from CoreWeave, networking infrastructure from Arista, and high bandwidth memory from Micron. These aren't speculative bets on which AI model will win or which chatbot will dominate. These are the companies building the roads, bridges, and power plants of the AI economy. Regardless of whether OpenAI, Google, or Meta ultimately dominates, they all need to buy from suppliers like these 3. This is what I call getting rich without getting lucky, investing in the inevitable infrastructure of a technological revolution rather than trying to pick the single winner. Now, a word of caution. Smaller growth stocks are inherently more volatile than large cap value stocks. These companies can swing dramatically in both directions. Make sure you understand what you're buying, size your positions appropriately for your risk tolerance, and think about your overall portfolio balance. The worst thing you can do is panic sell during a temporary drawdown because you over-allocated to volatile positions. But if you can handle the volatility, the opportunity is clear. The Fed is cutting rates. AI infrastructure spending is accelerating. And these 3 companies are positioned right in the middle of that perfect storm. The question isn't whether AI infrastructure will grow. That's already happening. The question is whether you'll position yourself to benefit before the next wave of rate cuts pushes these stocks even higher. Thanks for watching. If you found this valuable, let me know in the comments which of these 3 stocks you find most compelling and whether you think the Fed's rate cuts will accelerate AI spending even faster than expected. See you next time. Watch the next video coming up on the screen now.